March edition of the Asset Management Strategies newsletter. The U.S. stock market continued its climb, adding just over 3% to the S&P for the month. International equities were pretty much flat for the month, but much of the media is concerned that this rally can't last, which is the same as all rallies, where some pundits will always see the glass as half empty. That is basically what makes a market. We finally saw a short-term close to the Greek debacle as they were able to negotiate a plan to kick the can down the road for at least several more years. They'll have a difficult task ahead of them as they change a culture where over 30% of the population works for the government. No country can survive such a self-feeding strategy. I've attached an article to the newsletter from the National Review titled "We're Already Europe." As a percentage of gross domestic product, our national debt is still behind only Greece, Italy, Ireland, and Portugal in Europe. We're at 102% of our gross domestic product on a debt level, but we're projected to pass their levels in the next couple of decades. We still have time to change that course, but unfortunately, I think the largest deficit we face is that of leadership in both parties in what is a dysfunctional government system that has not been responsible. Let me put it in perspective a different way. In 1909, our U.S. budget was $800 million for 90 million people, which is just under $9 per person. By 2009, that number rose to $3.5 trillion for 300 million people, which comes out to $11,675 for every man, woman, and child in this country, and that's an increase of over 14,000 times. Do we really need that much more government than we did 100 years ago? On the bright side, looking at our slowly recovering economy, I'm reminded of a quote from Mark Twain who said, "The report of my death was an exaggeration." Despite our massive debt, we continue to learn to prosper. Just like Tiger Woods did last month, returning to the winner's circle after 2 years, I wouldn't write this economy off just yet. There are still massive levels of cash sitting on the sidelines, making nothing for corporations and individuals that will come back into the market. Apple, for example, just announced a $10 billion stock buyback program. And also keep in mind that in addition to the cash on the sideline, the bond market is 3 times bigger than the equity market. And when interest rates start to rise, those bonds will lose value, and the stock market will look pretty attractive to those dollars. So we remain 100% invested on the equity side, and we'll be more than happy to stay there as long as this rally continues to show signs of life. And when it runs its course, then we'll look to be more cautious. But we think that this run could go on for several more months. That's it for this month. Thanks for listening.